Holy smokes, everyone. BlackRock is warning there is much more pain coming for the worst bond market crash in US history. So what do they know? And that's right, this is the worst bond market crash we have seen in over 250 years of United States history. So this is going to have big consequences for Wall Street. This is going to have big consequences for the banks and the global economy. So you all need to wake up and pay attention to what's happening right now. And also in this video, I'm going to tell you, is BlackRock right? And how can we take advantage of this big, huge crash that's going on right now? Because we all know when there's blood on the streets, maybe we could find some absolute bargains. So you know what time it is, ladies and gentlemen. Let's get straight into the news, the facts, and the data. So look at this, everyone. BlackRock warns the worst US bond rout in history is far from over. So that's right. This is not clickbait. I'm going to show you how we've never seen a bond market crash like this ever. That's right. Ever, everybody. So we go ahead and dive. Let's go ahead and dive deeper into this report. So the US bond market is in the throes of an unprecedented 3-year rout, and sell-off has room to run further, according to the world's biggest asset manager. So that's right. I'll go ahead and adjust this here so it's easy to read. BlackRock is the biggest asset manager in the world with over $10 trillion, so they can make or break the markets. So maybe should we do the opposite of what they're saying? Well, let's keep on reading and find out. So the benchmark 10-year yields have already more than quintupled since the end of 2020 as the market reeled from the impact of decades-high inflation, a steep surge in interest rates, and fears of a foreign debt crisis. So that's exactly right, everyone. Interest rates on the 10-year has gone from around 0.3%. It almost hit 5%. Now they're coming down because this is what we're seeing, a flight to safety. We're seeing gold and silver go up as well because of conflict that's breaking out in the Middle East. And this becomes a much more broader conflict. People may run to safe havens like gold and bonds, but the worst of it may not be over if the Federal Reserve keeps on lifting interest rates. But we'll get into that later in the video if the Federal Reserve will actually go ahead and do this. Again, like they said, high inflation is still surging, and fears of a foreign debt crisis. Because what's been happening lately, the dollar's been surging. So what that means for the rest of the world, because remember, the rest of the world all holds U.S. treasuries, U.S. government debt, and U.S. dollars. When they get a loan from the US government, and if the dollar goes up, well, then they need to use more and more of their currency to repay back that debt. But if they don't have enough money, or if they're already struggling from record high inflation, well, they're going to have two problems. Either print more money and make inflation worse in their country, or they're going to have to severely cut spending to repay the debt, and their economy is going to implode. So let's keep reading. So the rise in yields accelerated in recent weeks, spooking traders across asset classes. That's exactly right. Again, worst crash in history. After the Federal Reserve last month signaled rates will remain high for longer as inflation risk linger. So that's exactly right, everyone. But again, will the Federal Reserve keep on lifting interest rates to do their job to bring inflation down, or will they prioritize the war that will be coming, and will they throw inflation to the side, sacrifice inflation for what they will say will be the greater good? We'll get into that a bit later on. So in the fourth quarter update to its investment outlook, BlackRock said it will avoid investing in long-term US bonds as it expects yields to continue their climb, and yields rise when bond prices fall. So that's exactly right. Yields rise, bond prices fall. And I agree. I would stay away from long-term debt for now, especially me. I don't feel confident lending money to the government over 10 years, but there may be some other options, which again, we'll get into later in the video. So we will steer clear of long-term US bonds even after their surge. Why? Well, they think the premium, the compensation investors demand for the risk of holding long-term bonds will rise further. That's exactly right. The debt is absolutely surging out of control for the US, and now they're not only going to be funding the Ukraine conflict, they're going to be funding the Israeli Palestine conflict. Then that means the debt is going to keep on surging high, everyone. And we're not even in a recession. What happens if we enter a recession? Are they even going to have any money left over for the average US citizen? All their money is going to conflicts around the world, and all their money is going to illegal immigrants that are crossing the border in their millions. And the unfortunate thing that's going to happen is means for the actual taxpayers, for the people actually funding all these conflicts, well, guess what? There'll be no money left over for you. Now listen to this, everyone. This is absolutely crazy. The iShares 20 plus year Treasury ETF, which tracks longer duration US government bonds, has tumbled a whopping 46% since the end of 2022. During the same period, the 10-year Treasury yields have jumped to 4.72% from 0.9%. And I'll bring up this chart here. I'm going to go ahead and adjust it here. We can see, look at this crash. I'll move myself so you can see this chart better. This is absolutely massive, everyone. We can see it looks like a pump and dump pretty much on this chart here. We see interest rates were only dropped from 2007 all the way to 2020, and people thought that interest rates will stay low forever. Well, because of this recent surge, now the bond market has completely imploded. So what else are they warning about here, everyone? Well, the ongoing Treasury rout ranks as the deepest bond bear market in the 247-year history of the US. So that's right, everyone. The worst crash in US history. Now, if it's the worst crash in US history, could it mean that this is the best buying opportunity in US history? Well, we'll just have to wait one moment. Let's keep on reading. So the persistent inflation pressures will boost the 10-year yields to 5%, a level last seen in the mid-2007, our strategists wrote, and the annual inflation rate in the US edged higher to 3.7% in August from a 2-year low of 3%. We'll have to wait to get the latest inflation figures to see what else is happening. So a surge in the supply of bonds is also weighing on prices. US government debt climbed past an unprecedented $33 trillion last month, doubling in the past decade. So that's absolutely right. You have less and less banks, less and less investors buying these bonds. You have the Federal Reserve selling bonds on their balance sheet, and they've got over $8 trillion worth of bonds and mortgage-backed securities to sell. At the same time, the US government is so in debt, they're having to add more and more supply of bonds onto the market. So you don't have to be a genius analyst. Simple economics 101. More supply, less demand, prices have to fall. And this has led even Ray Dalio to send out a warning. As got several experts, billionaire investor Ray Dalio cautioned in June the US is at the start of a classic late cycle big debt crisis, categorized by a shortage of buyers for its bills and bonds. Veteran economist Nouriel Roubini also expressed similar concerns. Now, like Blackrock says here, he still prefers short-dated US bonds. And I completely agree. I think if you're uncertain on what to do right now, if you've paid off all your debt, if you've got your emergency fund, not financial advice, but what I would be doing, if you're not sure what to do right now because there's so much uncertainties with the conflict breaking out and what the Federal Reserve will do, well, at least you can park it in a 3-month or a 6-month Treasury bill and get around 5.5%. So it's not great, but it's not the worst either. Now, what we have to talk about, what caused the banking crisis in March? It was interest rates going up. Well, interest rates have just spiked even further than the banking crisis in March. And do you know what this means? The banks are sitting on over $600 billion in unrealized losses. And the banks have to realize those losses, well, we could see more bank failures. And even if they don't realize those losses, if we see a lot of investors get spooked by what's going on in the banking industry and they all try to pull out their money, well, what do the banks have to do? Even if they thought, well, don't worry, we'll hold these to maturity, they're going to have to sell them no matter what and sell them for a big loss. So look at this. Go ahead and scroll up here. US banks have 620 billion of unrealized losses on their books. So we can go ahead and I'll adjust this here so you can get a better view. Banks' equity could take a hit if paper losses had to be realized. So for most banks, unrealized losses are a manageable problem, but investors and depositors remain jittery about lenders sitting on a huge pile of money-losing bonds. Like I just said, if investors get spooked, well, they're going to do a run on the bank, and the banks are going to have to realize some of those losses. So we can see here, banks with total assets of 25 to 50 billion, who has the biggest ratio of unrealized losses? Well, look at this. Charles Schwab, Premier Bank, 329 billion. We can see here Simmons Bank, 35%. Prosperity Bank, 48%. Now let's go to banks in the 50 billion to 100 billion range. Well, that is Citibank, City National Bank, Webster Bank, and Santander Bank at 13 and 14%. But now let's go to some of the bigger players here. We can see 100 billion to 200 billion. We have USAA Federal Savings Bank, 103%, Northern Trust Co., 21%, and Huntington National Bank. So if any of you guys are banking with these banks, you should probably, have a second look at parking some money elsewhere. Now, 200 billion to 500 billion, Charles Schwab Bank, 167%. Silicon Valley Bank, which of course collapsed, they had 100%. And let's get into now the big boys, 500 billion plus. This is who I've been warning. Who's out of the big four, who is at most at risk? Well, that's Bank of America, 65%, followed by US Bank, 36%, and Trust Bank, 38%. So that's right, everyone. These banks are facing huge losses, and if there is a black swan event, like a full-blown World War III, I wish that doesn't happen, or a full-blown conflict in the Middle East, because the conflict in the Middle East is escalating very, very quickly. We're seeing all the Middle East countries pretty much, they're teaming up with Palestine, they're teaming up with Gaza, saying to stop bombing Gaza. We're seeing some potential Hamas militants in Syria. We're seeing Hezbollah in southern Lebanon. They're looking like this may turn into a multi-front conflict, and this could create a black swan event and huge runs on the banks. Now, what we have to figure out, what could this lead to the Federal Reserve to do? Well, like I talked about in my previous video, what they did during World War I, inflation surged, and you would have thought they would lift interest rates. Well, no. During World War I in 1914 and 1918, it was a little bit different. They didn't have the federal funds rate, but what they did is they did a big discount on loans secured by Treasury securities, and they also financed the debt by increasing their holdings from 66 million to 236 million. Again, it doesn't sound like a lot of money because back then the US all had a lot more purchasing power, but in today's numbers, that's like the US Treasury or the Federal Reserve's balance sheet going from 8 trillion to 24 trillion, okay? Same thing, World War II. The Federal Reserve Committee maintained a peg. They dropped interest rates pretty much to zero, at 0.38% for Treasury bills, which was significantly lower than peace times of 2 to 4%. So, what could happen? I think right now, a good play could be to park some money in short-term treasuries, also buy some gold, because gold is seen as a safe haven. We've seen a recent sell-off with gold, so it is at a bit of a discount right now. But this could create a big buying opportunity if the Federal Reserve flips and the Federal Reserve starts monetizing the US government debt. They throw inflation to the curve and say, look, don't worry about inflation. We need to fund this conflict because peace and safety is our number one priority, everyone. So we'll have to wait to see what the Federal Reserve reaction is in the next Federal Reserve meeting. And I'll definitely keep you updated, because when I do these predictions, I do it based on the Federal Reserve doing the right thing. But we all know they don't always do the right thing. They know for the people, they do what the right thing is for the banks and for the US government. So, everyone, what do you think about all of this? Thanks for watching. You're awesome. I'll see you all in the next video.